Hello and welcome. I'm Harm Hoenstra, Director and Deputy Head of Corporate Services at MSA. Operating a business in China means navigating a unique and often complex tax landscape. Understanding China's tax system is not just about compliance. It's about optimizing your financial strategies and ensuring your business thrives. Today, we'll demystify the key taxes and regulations you need to know. Whether you're a new entrant or an established entity, staying informed about China's tax framework is absolutely essential. Let's explore the fundamentals of China's tax system and how it impacts foreign companies. China's tax system is comprehensive and multi-layered, playing a significant role in both central and local government revenue. It's designed to be progressive, with different rates applied based on income levels and types of transactions. For foreign companies, understanding the applicable tax laws is crucial for legal operation and financial planning. The primary tax laws governing businesses and individuals in China include the corporate income tax law, the value-added tax law, and the individual income tax law. Compliance with these laws and their implementing regulations is mandatory for all enterprises operating within the country. Let's break down the most impactful taxes for businesses and individuals in China. Starting with corporate income tax, or CIT. This tax is levied on the profits of both domestic and foreign companies operating in China. The standard CIT rate is 25%. However, various incentives and preferential tax rates are available for specific industries and qualifying enterprises. For instance, for profits below 3 million RMB, there's currently a temporary reduced CIT rate of 5%. This policy is in place until the end of 2027. Additionally, companies that are registered as a high-tech and new technology enterprise can enjoy a reduced rate of 15%. And next to this, there's still a wide range of local and industry-specific preferential policies applicable in China. So it is advised to research this carefully to optimize your company's tax position. Secondly, there's the value-added tax, or VAT. VAT is a consumption tax applicable to businesses and individuals involved in the sale of goods, provision of services, or importation of goods. In China, businesses are classified either as a general VAT taxpayer or a small VAT payer, each with different filing requirements and tax treatment. To learn more about this, you can check our VAT video on our YouTube. For VAT, standard rates vary from 13% for most goods, 9% for certain goods and services, such as logistics, and 6% for specific services like financial, modern, IT, and consulting services. Small-scale taxpayers pay a reduced 3% or currently, according to a temporary policy, even only 1%. And lastly, exported goods and certain cross-border services may qualify for a 0% VAT rate. Individual income tax, or IIT. IIT is a progressive tax that's levied on the income of both residents and non-residents. Residents are classified as individuals with domicile in China or who are staying over 183 days in a tax year in China. This means that they are generally taxed on their worldwide income. However, there is a rule exempts foreigners from global income tax for a period of 6 years, which can be reset if they leave the country. Non-residents in China are typically taxed only on the income that is sourced within China, so any kind of global income is not taxable. The IIT system features progressive rates ranging from 3% at the lowest to 45% based on different income levels. When it comes to the compliance side of this, employers are responsible for calculating and withholding IIT on behalf of their employers. It is important to note that various deductions and exemptions, including special additional deductions for items like children's education or housing rent, which can significantly lower taxable income, are applicable in China. Some other important taxes to still mention include the consumption tax. So this applies to the manufacturing, import, or sale of certain luxury goods or those harmful to health. There's custom duties, which are levied on imported goods. Stamp duty, which is applied to certain legal documents and accounting books. And lastly, withholding tax, In China, a 10% withholding tax, which is reduced from a statutory 20% normally, is typically applied to passive income such as dividends, interest, and royalties paid to non-resident enterprises, although there are still double taxation agreements in place which may lower these numbers. Navigating China's tax system requires meticulous attention to detail and adherence to strict filing requirements. Companies must regularly calculate and file their taxes, ensuring accurate record keeping and timely payments to avoid penalties. The tax authorities in China are vigilant, and maintain full compliance is paramount. Here's a breakdown of typical compliance deadlines. Firstly, monthly filing. Most companies in China are required to file VAT and surtaxes, as well as individual income tax withholding on a monthly basis. These filings are generally due by the 15th day of the following month, except for when this day falls on the weekend or in a month with any holidays. So for example, January's VAT and IIT will be due on February 15th. Next, there are quarterly filings. Corporate income tax is typically filed quarterly, with provisional payments made based on estimated profits. These quarterly filings are also due by the 15th day of the month, but in this time following quarter end. So April 15th for Q1, July 15th for Q2, and so on. Then there's annual filings. An annual corporate income tax reconciliation and settlement is required for all companies due to its quarterly settlement and payment. This comprehensive filing typically covers the entire previous calendar year and is due by May 31st the following year. So for example, the 2025 annual corporate income tax filing would be due by May 31st, 2026. This annual process includes a final calculation of the company's taxable income and CIT liability, taking into account all provisional quarterly payments made throughout the year, which will then result in either a supplementary payment, a refund, or exactly zero. Maintaining accurate financial records, preparing comprehensive accounting books in Chinese, and adhering to these specific deadlines are non-negotiable for all foreign vested companies in China. China's tax system is complex, but with the right expertise, it's entirely manageable. Understanding the various tax types, rates, and detailed compliance requirements from monthly VAT to annual CAT reconciliation is fundamental to operating successfully and efficiently in the market. At MSA, our team of experienced tax professionals specializes in guiding foreign companies through China's intricate tax landscape. We provide comprehensive tax filing services, strategic advisory, and ensure you remain fully compliant while optimizing your tax position. Don't let tax complexities hold your business back. Contact us today to learn how MSA can support your operations in China. Thank you for watching, and don't forget to subscribe to our channel for more insights on doing business in China.